Right now, Wall Street is financing the United States government. It is buying treasury bonds. It is underwriting deficits. It is helping keep interest rates manageable. On the surface, it looks like loyalty, like confidence, like belief in the American system. But at the exact same time, Wall Street is betting against America, not emotionally, not ideologically, mathematically. This is the contradiction that defines modern American power. The same institutions that fund the U.S. government, stabilize its markets, and profit from its dominance are simultaneously positioning for its decline. And this isn't hypocrisy. It isn't betrayal. It is how capital has always behaved at the peak of an empire. Because capital does not have citizenship. It does not have loyalty. It has incentives. And when incentives change, capital moves, quietly, legally, and long before the population realizes anything is wrong. To understand how Wall Street can fund America while betting against it, you have to understand one core truth. Funding the present and betting on the future are not the same thing. In fact, they are often opposites. Empires collapse not because capital leaves too early, but because it leaves late. The smartest money stays just long enough to extract maximum benefit, then hedges, diversifies, and exits before the decline becomes obvious. That is exactly what is happening now. This story is not about patriotism. It is not about conspiracy. It is not about secret meetings. It is about incentives embedded in the financial architecture itself. Once you understand those incentives, the behavior becomes predictable, almost boring, and deeply unsettling. Let's start with a basic question. Why does Wall Street still fund America? The answer is simple. Because it's still profitable. U.S. Treasury bonds are still considered the safest collateral in the global system. Dollar-denominated assets still dominate global finance. American capital markets are still the deepest, most liquid, and most sophisticated in the world. If you manage trillions of dollars, you cannot ignore the United States. You must participate. Funding America is not a political statement. It's a structural requirement. Banks buy treasuries because they are required to. Pension funds hold them because regulations demand safety. Insurance companies use them to match liabilities. The Federal Reserve uses them to conduct monetary policy. Global institutions treat them as risk-free anchors. This creates enormous, constant demand for U.S. government debt. And that demand allows the United States to borrow at a scale no empire in history ever achieved. Trillions per year, decade after decade. From the outside, this looks like confidence. From the inside, it is obligation. But funding the present does not mean believing in the future. Wall Street understands something the public does not. The dollar system does not need to collapse to become unprofitable. Decline does not look like a crash. It looks like erosion. And erosion can be traded. To see how this works, you have to separate cash flow from capital positioning. Wall Street makes money in three primary ways: fees, spreads, and asset appreciation. As long as the U.S. government continues borrowing, issuing debt, and running deficits, Wall Street profits. It earns underwriting fees. It trades bonds. It collects interest. It arbitrages policy. In other words, America's debt is a revenue stream. But Wall Street does not hold that debt unhedged. This is the critical point. While Wall Street funds America's spending today, it simultaneously hedges against the long-term consequences of that spending. Inflation, currency debasement, geopolitical fragmentation, and declining real returns. This is how it bets against America without ever saying so. Let's walk through the mechanisms. First, consider inflation. When the government borrows heavily and the central bank monetizes that debt, inflation becomes inevitable over time. Not necessarily in a straight line. Not necessarily every year. But structurally. Wall Street knows this. So while it holds nominal assets like treasuries, it also positions in real assets. Commodities, energy, infrastructure, real estate, anything that benefits from currency debasement. This is not ideological, it is defensive. If inflation rises, bond values fall. But real assets rise. Wall Street doesn't choose one. It owns both. The public, by contrast, mostly owns the currency. Second, consider duration risk. Long-term U.S. debt is extremely sensitive to interest rates. A small rise in rates causes large losses in bond prices. Wall Street mitigates this through derivatives, interest rate swaps, futures, options. These instruments allow institutions to collect yield while transferring duration risk elsewhere. Who absorbs that risk? Often pension funds, insurance holders, and retail investors indirectly. Wall Street earns the spread. The public absorbs the volatility. Third, consider currency exposure. The dollar is still dominant, but its share of global reserves has been slowly declining. This is not collapse, it is diversification. Central banks are adding gold. Regional trade agreements are settling in local currencies. Energy trade is slowly fragmenting. Wall Street sees this early, and it positions accordingly. It increases exposure to foreign markets, emerging economies, strategic competitors, not because it prefers them politically, but because capital flows toward growth and away from saturation. This is how Wall Street can finance U.S. deficits while expanding into China, India, Southeast Asia, and the Middle East. It is not choosing sides, it is hedging trajectories. This is exactly what British capital did in the late 19th century. As Britain financed its empire through debt and controlled global trade, British investors poured money into American railroads, steel, and manufacturing. They funded Britain while building America. When the pound lost dominance, British elites were already diversified. The public was not. This is the pattern repeating. Now consider financial innovation. Wall Street profits most not from direction, but from volatility. When systems are stable, margins compress. When systems are stressed, margins explode. Debt accumulation, geopolitical tension, currency uncertainty, these are not problems for Wall Street. They are opportunities. Derivatives, markets expand. Hedging demand increases. Liquidity premiums rise. Complexity increases. Fees increase. Wall Street does not need America to collapse. It needs America to become more complex, more indebted, more volatile. That is the sweet spot. And complexity always rises before decline. Now let's address the illusion of alignment. Politicians talk about national strength, trade wars, economic nationalism, reshoring, strategic competition. It sounds like confrontation, but capital allocation tells a different story. While Washington talks tough, Wall Street allocates globally. It invests where returns are highest, regulations are favorable, and growth is fastest. It does not wait for permission. It does not wait for consensus. This creates a split reality. The political narrative is conflict. The financial reality is integration. This is why trade wars rarely reduce capital flows. Tariffs change trade routes, capital routes around them. It always does. You cannot decouple an economy while your financial system remains globally integrated. And the U.S. financial system is the most globally integrated system on Earth. Wall Street does not fight China. It finances it, it underwrites it, it indexes it, because that is where growth is. This is not a moral judgment. It is structural logic. Now let's talk about leverage. The American system is built on leverage. Government debt, corporate debt, household debt, financial leverage. Leverage magnifies returns on the way up. It also magnifies losses on the way down. Wall Street manages this asymmetry by externalizing tail risk. When leverage works, profits are private. When it fails, losses are socialized through bailouts, monetary easing, inflation, or regulatory forbearance. This is not speculation. It has already happened multiple times. Regional banking crises. Each time the response is the same. Liquidity is injected. Losses are contained. The system is stabilized. Wall Street understands this reaction function. It prices it in. That is how you can take aggressive risk while appearing conservative. That is how you can fund the government while betting against the sustainability of the system that government represents. Now consider demographics. America's population is aging. Entitlement obligations are rising. Productivity growth is slowing. Debt servicing costs are increasing. These are not partisan issues. They are arithmetic. Wall Street does not debate them. It models them. Long-term models show lower real growth, higher inflation risk, and increased fiscal pressure. That does not mean collapse. It means lower future returns on traditional assets, so Wall Street adapts. It shifts toward private markets, private credit, private equity, infrastructure, assets less exposed to public market volatility and more protected by contractual cash flows. The public, meanwhile, remains exposed to public markets, public debt, and public currency. This is how divergence happens. Funding continues, hedging accelerates. Now let's talk about the most misunderstood aspect of this entire system: confidence. The dollar system runs on confidence. Confidence that the U.S. will honor its debts. Confidence that markets will remain liquid. Confidence that the Federal Reserve will intervene when necessary. Wall Street is not trying to destroy that confidence. It depends on it. But confidence does not require belief in permanence. It only requires belief in near-term stability. This is the key. You can believe the system will function for the next 5 to 10 years while doubting its viability over the next 30. And Wall Street operates on that timeline. Public narratives are long-term. Political promises span decades. Financial positioning is granular, adaptive, and reversible. This is why decline is never obvious in real time. As long as markets function, as long as liquidity exists, as long as interventions work, the system appears healthy. But beneath that surface, positioning shifts. More hedges. More diversification, less concentration. Less exposure to any single outcome. This is not collapse behavior, it is exit preparation. And exit preparation always looks like confidence, until it doesn't. Now let's address the uncomfortable truth. Wall Street does not need America to succeed. It needs America to function. Success implies rising real wages, productivity-driven growth, and broad-based prosperity. That environment compresses financial margins. It reduces volatility. It limits leverage. Functionality, on the other hand, means debt issuance, asset inflation, policy intervention, and complexity. That environment is ideal for financial intermediation. This is why financial profits can rise even as living standards stagnate. Wall Street is not anti-American. It is post-national. It operates in a system where states provide legal frameworks, currencies, and enforcement. But capital flows according to return, not allegiance. This is not new. It is how finance has always behaved at scale. The difference now is that the United States is on both sides of the equation. It is both the issuer of the dominant currency and the host of the dominant financial institutions. That creates the illusion of alignment, but alignment ends when incentives diverge, and they are diverging. The government needs low interest rates, stable demand for debt, and currency confidence. Wall Street needs volatility, yield, and optionality. Those goals overlap until they don't. When inflation rises, when debt servicing costs increase, when geopolitical fragmentation accelerates, Wall Street adapts faster than the state. It always does. This is why the biggest risk to the American system is not external enemies. It is internal misalignment between political narratives and financial incentives. The state speaks in terms of sovereignty. Capital speaks in terms of risk-adjusted return. And capital always moves first. So when you see Wall Street funding U.S. debt, do not mistake that for belief in American permanence. It is belief in American utility. The system is still useful, still liquid, still profitable. But usefulness is not forever. Every empire in history reached a point where its system continued functioning long after its fundamentals began eroding. During that phase, capital stayed, but prepared. That is where America is now. Funding continues, hedging accelerates. This is not betrayal, it is pattern. And patterns do not require intent, they require structure. If you want to understand what happens next, stop watching political speeches. Start watching capital flows, watch diversification, watch hedging behavior, watch where long-term investment is going, not what people say. Because Wall Street will never announce that it is betting against America. It doesn't need to. The bets are already placed. And by the time the outcome becomes obvious to everyone else, the positioning will be complete. That is how this always ends. Not with a crash, with a quiet transfer. If this changed how you see markets, debt, and power, then you're beginning to understand how the system actually operates. Not as it's described, but as it functions. And once you see that, you can never unsee it.